Hello, everyone. My name is Yafeng Yim. I'm a professor and interim chair of the Department of Civil and Environmental Engineering, University of Michigan. Welcome to the University of Michigan Building the Future Distinguished Lecture Series. In 2019, our department finished a 2-year strategic planning exercise through which we identify 5 strategic directions. So they are enhancing human habitat experience, shaping resource flow, adaptation, automation, and smart infrastructure finance, which is the topic of today's webinar. So this direction examines new financing instruments for public and private infrastructure investment, including new approaches to monetizing infrastructure data. So this is a very exciting focus of our department and also the profession as a whole. Our strategic vision reaffirms our value proposition to our communities and reinforce our commitment as engineers working in service to society. And to highlight our vision and to formulate a work plan, we launched the Building the Future Distinguished Lecture Series, which provides a forum to discuss each strategic directions. It's aimed to build a broad community network that includes industry professionals, researchers, educators, and the students. Through presentation from leading experts and panel discussions, this series provides new perspective and new insight and explore a range of perspective on the 5 strategic directions. So we have had a lot of support to make this vision and today's webinar come together. We would like to thank our co-sponsor of today's event, Center for Finance, Law, Policy, University of Michigan, Integrated Roadways, Michigan Ross FinTech Initiative, and Michigan's University Research Corridor. I would also like to thank Strategic Implementation Committee led by Professor Shanyun Li. In addition, Professor Li has agreed to serve as the moderator for today's presentation and panel discussions. I also would like to thank Joyce Kennedy, Michelle Santillán, and Rebbe Vagiz for providing technical and marketing support to today's webinars. A few more words about the accessibility of the webinar. We'd like to make our event more accessible to all participants. So this webinar will have a live automated captions, a transcript will be available. And to choose a viewing option, click live transcript on the control bar at the bottom of your screen, where you can show and hide the subtitle or view the full transcript. So I will now turn the session over to Professor Li. Shanyun, over to you.
Yeah, thank you, Yafeng. Again, I would like to welcome everybody participating in today's event. During the lecture and panel discussion, I invite participants to send in your questions using the Q&A function, and we'll try to get to as many of your questions as time allows. Now, I would like to introduce our very special speaker and panelist. We are very fortunate to have Peter Adrians, Professor of Civil and Environmental Engineering, Finance and Entrepreneurship at the University of Michigan, who will speak to us on smart infrastructure finance, the transformational role of the data for democratized digital project delivery. The presentation by Peter will be followed by a panel discussion with 3 distinguished panelists, Britannia Forter-Kane, Mayank Gupta, and Tim Sylvester. Britannia Forter-Kane is the executive director for Michigan's University Research Corridor. Mayank Gupta is the director of data analytics and digital solutions at WSP. Tim Sylvester is a CEO and chief technology officer at the Integrated Roadways. This brings us today's distinguished lecture. So now let me invite Peter to speak his theme and give his presentation. Peter, please.
Is this clear?
Yes.
Okay. Well, good afternoon, everyone. It is actually pretty unusual that a faculty of the department would speak rather than an outside speaker. But this field is such a new kind of meta discipline that I thought it would be useful, particularly the second time that we're giving these types of strategic lectures, to actually give an overview and even the motivation as to why we're moving in a direction of smart infrastructure finance. So I lead a Center for Smart Infrastructure Finance here at the University of Michigan, as well as I'm program director of a new Master of Engineering in Smart Infrastructure Finance. So what I'm going to do is not necessarily go into the details of the research, but really provide, it's a strategic lecture, so the strategic overview and direction as to how we ended up here. So it really all got started about 7 years ago or so, when I had an opportunity as a Finnish Distinguished Professor at the Research Institute of the Finnish Economy to think about new financing models to help transition the country of Finland to a low carbon economy. That was the entire idea behind this project. There are no such financing mechanisms. Typically, you have to choose for, are we going to do renewables? Are we going to do water recycling? Are we going to do cradle to grave investment in materials? So what they wanted to do is sort of a systemic investment in a low carbon economy. And because there was no instrument like that, we put together a group of about maybe 15 people, all sorts of investment professionals, to start looking at new financing mechanisms around the existing assets in an economy. And when I say existing assets, I mean companies, I mean the infrastructure, and we mean all the new innovators in an economy, and bring them together essentially in a whole ecosystem and invest in that ecosystem. And in order to do that, there was a lot of data tracking that we needed to do, data tracking on how information, money, and everything else flows between parties in different components of the economy, which required us to come up with what we call algorithmic approaches to track financial money flows. And that's kind of where the financial technology piece comes in. And we ended up putting a book out called Financial Technology for Industrial Renewal. But let's start at the beginning. It all started in 1817. And when you tell a University of Michigan student or faculty member what's the meaning of 1817, and they should know right away, that was the founding of the University of Michigan. However, something else got started in 1817. The first set of municipal bonds was issued in the United States. And these were municipal bonds that actually impacted our environment pretty close by. It was to build the Erie Canal. So it was the first time that governments issued a debt instrument that was then paid back using fees and taxes to build a large infrastructure project. So that was also 1817. So that's easy to remember. Tell students in my class 1817, and they all know. It's either the founding or it's the first municipal bonds. So over time, municipal bonds have what we call, they've built America. And I'm not going to go through all the numbers, but if you look at these numbers here, from wastewater treatment plants to dams to waterways, bridges, mass transit systems, et cetera, and you see the chart on the right, I mean, there's a lot of infrastructure that is built, public infrastructure, that is built and has been built in the US since 1817, that essentially has furthered all the goals and objectives and services to society. At this point in 2021, there's about $3.8 trillion in municipal bonds, debt bonds outstanding to fund. About 70% of that is in infrastructure systems. Now, infrastructure systems, of course, have changed over time. It was the Erie Canal in 1817, and now we're starting to talk about things like, the CAVNU, autonomous roads. We start talking about wireless charging. A couple of examples here, going from the right to the left. I mean, it actually just popped up in my Facebook feed. Sometimes Facebook is useful. And I didn't even know that. I'm originally from Belgium, but I didn't know that the Dutch trains, for example, run on wind energy. So windmills actually power the trains. You can see these numbers. It's actually funded using or financed using a municipal bond. Municipal bonds have shifted to in sort of the flavors that they've taken on. I mean, you see all the way on the left, we have now green bonds, and green bonds is they raise money specifically to finance a green project or a project that is in compliance with the green loan principles, right? So where you look at carbon outputs, material savings, water savings, et cetera. There are ESG bonds, sustainability bonds, all different social impact bonds. So basically, the flavor of the bond has changed depending on the project that gets financed and the metrics that get measured along the way as you're financing that project. And particularly now that we're moving more and more into the sustainability space in the US and in Europe and everywhere else, finance and sustainability is very closely integrated. In the middle, we see something altogether different, but there is actually a government bond behind that as well. And that's Bitcoin City in El Salvador, right? In El Salvador, they want to essentially raised a bond that's going to buy Bitcoin to deploy infrastructure assets in the country to not only to mine, for example, mine Bitcoin powered by renewable energy, and ultimately build out a new, the adoption of the Bitcoin currency in the context of El Salvador. And there's other countries that have sort of followed this path. So the features of the bond have evolved. As you see at the bottom, one thing that has prevailed is the way state and governments finance public projects is typically through bonds. Now, when you very often hear the words funding and financing, and in the media, that's very often sort of conflated into the same thing. It is not the same thing. And as we teach now in class, since last year, we offer, since 2 years ago, we offer a course in engineering project finance, talk a lot about funding and financing. So the financing mechanism is the source of the capital that you're going to be using for a project. What I've talked about so far essentially was a municipal bond. But there's all sorts there's bonds, there are notes, there is public-private partnership finance, there's all sorts of monies out there that one could go try and raise to build a project, or to both the capital to build a project as well as to operate and maintain it. So the funding mechanism is the money, is the cash flows that you need to actually pay for that financing. Much of the same way, I guess, how you would pay use your paycheck to pay your credit card. It's the same thing, right? So the credit card is the financing mechanism and your paycheck is the funding mechanism. The same goes for cities, states, counties, countries, and whatnot. They need to find funding mechanisms to pay for the financing mechanism. So very different, I guess, on how we talk about infrastructure in the context of funding and financing. And it is important because we need to always have enough funding mechanisms to pay the debt, right? If you don't have a paycheck, it's going to be very tough to get a credit card, or you're going to get one with a very high interest rate. So we're starting to talk more about what we now call the bonds of inequality. And the reason is this, right? So a lot of the time, the way we pay for that infrastructure, the way you pay for the financing of the infrastructure is through income taxes, is through special taxes, is through fees and whatnot. And you can already imagine that, more economically disadvantaged communities do not have the same capacity to either raise taxes or pay fees to actually fund the financing of their infrastructure, which is why you get different quality. And just two pictures here, I guess, on top of school in Detroit and the bottom school in Ann Arbor, right? So you get different kinds of infrastructure, you get different types of water systems. And so there's a whole challenge that we now call the bonds of inequality. And that is only exacerbated, right? There's a lot more haves and have-nots in the nation. We hear about it every day. And it's not only about Flint, but it's, about many different communities where we hear where infrastructure is breaking down, and other counties, cities, states, where the infrastructure is of high quality. And the big challenge is that there is not enough funding to pay for the financing. And ultimately what we ended up with is this disconnect, or this underfunding of infrastructure. And again, I'm not going to go to the table from the Center on Public and Budget and Public Policies, but you can look at sort of where the numbers are right now in terms of what we need. And of course, a lot of that was the motivation behind the Biden infrastructure bill. So the same goes for, going back to taxes, because taxes are typically a political football, right? We hear about it every election cycle. We don't want to pay taxes. The big problem is, look here at the Federal Highway Trust Fund is actually going negative this year, right? That's the red. It's the expected shortfall is going to be about 190 billion. The reason for that is that 87% of the funding that pays for this fund is based on gas taxes, and we haven't raised gas taxes in 28 years, right? So taxes and tax cuts are very intimately linked to the kind of infrastructure you can actually afford to build. If you don't have the revenue streams, you do not have the financing capability, and therefore not the infrastructure that you want. So the question is, can we do better? Is there a way around that? And so we're going to be talking a little bit about that later on. So as cities and states don't have, and countries don't necessarily have enough of their own revenue or financing capability, what has sort of stepped in that place is more participation from the private sector in infrastructure finance, right? So through public-private partnerships, which is really a whole spectrum of things, going all the way from infrastructure being public on the left to infrastructure being completely private on the right. The public-private partnerships, it's sort of right in the middle. Now, even within public-private partnerships, it's a very squishy term. There's a lot of things that are meant underneath that. I'm only want to focus on the green highlighted boxes here, because this is where you see a big F and we see joint venture in green. And what that means is that the private sector actually starts co-financing the infrastructure, right? So if the public sector can't finance all the infrastructure, start asking, can the private sector help co-finance the infrastructure? Well, you could ask that. The big question then is, how are we going to pay the private sector's financing, right? Somehow the private sector's debt or equity or whatever the source of money needs to be paid back as well. And very often the private parties that are in these public-private partnerships have the right to raise fees or to otherwise monetize information or a toll road or whatever it is to actually make money back. It doesn't have to be a toll, it could be all sorts of revenue streams, right? And here's kind of how that kind of lays out, because the people behind, these public-private partnerships, the co-financing, or behind the joint venture where private parties and public parties both put money in the kitty, right, is that depending on what you're going to build, where it is social infrastructure such as schools and road transportation and hospitals, and yes, football stadiums are considered to be social infrastructure, or whether it's regulated infrastructure or demand-based infrastructure, there's going to be different asks. So the kind of money that comes into the public-private partnership is going to want a different return. The money is getting more expensive. Remember our bonds? We love our bonds. We love our bonds in part because they're cheap. It's only 2 to 5% interest, right? So all the other money that the private sector might bring to the table wants more. So the reason why it wants more very often has to do with revenue uncertainties, right? In social infrastructure that's completely funded by the state and whatnot, there's no issue. But once you go sort of more towards say airports and ports and projects like that, or to more uncertainty or volatility in revenue, the money that is willing to step into uncertainty is typically money that is more expensive. And so that's why we see public money, public-private partnerships, different mixes of public and private finance that want all sorts of returns. So we need to sort of try to find an answer to address these issues. And here, this still says iStock here on the pictures. I'm actually in the middle of rebuilding the website with a design firm, and we haven't paid for the licenses of the pictures yet. But megatrends, I guess, infrastructure has changed. Right? Megatrends are not driving a new motivation behind smart infrastructure finance. So infrastructure is as much about digitization, or much more about digitization, information flows, 5G integration than it used to be, right? So the infrastructure looks different, does different things, collects different types of information, which actually allows us to start building data-driven business models around that, or data-driven financing behind that. So the question is, can we get away from some of this traditional, the more uncertain the revenue is, the higher the cost of financing is going to be, by offsetting that through digital infrastructure? And that's what I'm going to talk about in my last couple of slides here, right? So the infrastructure gets redefined, business models get redefined around the infrastructure, and the financing gets redefined. So when we talk about, just going to go through this, it's still a slide from Jerry that he and I talked to in at Cambridge. But what is really smart infrastructure? Many of you work in the space of smart infrastructure. It's really sort of this whole confluence of computing, communication, sensing, and internet, right? The physical system is equipped with 5G. The information collected by the 5G systems, the sensors, actuators, is loaded into control systems, computing systems, and that information ultimately is used for decision making. But it also can be used for more than that. And that's kind of where we want to go. So if we assume that the direction of infrastructure is going to be more in this direction, then what are now the new opportunities around infrastructure and infrastructure financing? So here we're talking about the power of data and digital twinning, right? So basically the collection of data that are collected through these digital twins. These are multiple layers here around a city block in the city of Toronto, collects different type of information from physical systems, resource flows, social flows, all types of information. I have a couple of slides here in the middle that are one. This is from also from Professor Lynch's group, who of course left us last year, and then Smart Water from Professor Kirkus's group. But basically, as these new kind of data come out, they can get repackaged, and actually we get a new what we call information stack, right? There's an information stack that deals with operational savings, an information stack that deals with potentially derivative cash flows, new kind of revenue streams, and then a stack, part of the stack that is really the impact metrics such as ESG, environmental, social, and governance metrics on how an infrastructure asset is perceived. And I'm going to talk a little bit about each of these three. The question is this just a pure academic issue or pure academic thought process? 2 years ago, I went to a conference, Sustainable Finance, Infrastructure Finance Forum. It was Goldman Sachs organized that, were pretty much everyone who was attending that, aside from myself and actually a couple of people here from development, were all in the banking industry. And they said, look, we all are seeing that infrastructure sort of becomes kind of like Moneyball, right? For those that have seen the movie before, Moneyball is about extraction of new or hidden value in a baseball player, in the case of the movie, but here's new hidden value in infrastructure assets. And what is happening is that they say fixed income is the exciting asset class on the dice. What that really means is that, you remember how I was talking about the interest rates going up as a project becomes more expensive? Well, fixed income is typically kind of the cheaper kind of money. It's not as cheap as bonds necessarily, as municipal bonds, but it's sort of on the lower cost. And it becomes sort of a new, a renewal of this lower cost of capital type of money that becomes important in infrastructure. Why? Because we have new operational models, new revenue streams, what we call enhanced liquidity. What that means is we get more direct insights in the performance of an infrastructure asset, and we can start linking performance or financing to performance of an asset. So how does data change infrastructure financing models? Let me give you a couple of examples. This is taken from a 2x2 that Mayank Gupta and myself put together in a white paper for the country of Colombia. The Minister of Finance and Public Credit that read a paper, actually wasn't even a paper, it was an op-ed that I put out in Bloomberg City Lab, had read that. He loved sort of the data-driven financing models. He got in touch with the Department of the Treasury, Office of Technical Assistance. They got in touch with me and they say, hey, do you want to write a white paper around this stuff? And so I talked to Mayank. Mayank and I got together and we put this paper together. And we talked sort of generally about a 2x2 that on the one hand, on the X has the barriers to integration of these new models, right? Which is really about risk. And then 2, the upside potential. So what is the potential return for investors? So how do we deal with data in the context of infrastructure? And I'm going to give you one example for each, just very quickly. So on operational efficiency, I'm taking here a snapshot out of a paper by, was also from Professor Lynch's group, by Bahram Tahiri, I believe. I'm not sure who did this paper, where basically we're monitoring using load sensor structural health, right? So early detection of degradation of roads or bridges, and sort of then predicting from that, I guess, when maintenance is going to be needed. And I would call that, that is all part of operational efficiency. So early detection of structural health impacts is an operational efficiency thing. It's something that is sort of has a low barrier to entry because we do that anyways, manually already. We don't do it using 5G, we do this manually. The return is also pretty low. I mean, well, I guess low, it depends. You don't have to wait for catastrophic failure, I guess, to start repairing it. So you can probably get an early detection. The second one is cost of capital reduction. Very important, there's many different ways. Cost of capital means essentially all the costs that are associated with getting the money, right? Getting the money for your infrastructure. So therefore, trying to reduce the cost to municipalities on how much funding they're going to need for the kind of money that they need for infrastructure assets. This is a slide I took from one of our partners, Blockchain Triangle. And basically, what we're doing with them, and some of our students are getting involved in that project, is taking data from all sorts of assets, whether it is energy assets, road assets, pipelines, shipping, actually even agriculture. We're getting into smart financing of agriculture. Aggregate all this kind of data, provide the data connected to all the people that are involved in these assets and say, hey, we know all of this about the operations of these assets. Investors, what do you do about this? I mean, now that you know all this, how do you reprice the risk? So basically, a lot of data we collect are ESG data, environmental performance data, social performance data, governance data. And what it does is that it helps reduce the interest rate, the cost of the financing of the money. So if before you were paying 3.5%, you might take it to 3.2% or even 2.8% because you actually have real-time data on ESG. Again, barriers to integration, pretty easy because you're going to build the asset anyways. The upside potential is fairly low because all you're doing really is changing your cost of financing, but heck, it does make a difference to any municipality if their cost of debt lowers. Securitizing future revenues or savings. Very important for small communities. Actually, just a couple of days ago, I had an interview with NPR and Lester Graham. So many of you probably know Lester Graham if you listen to NPR. So they're doing a whole piece around infrastructure. And they said, we currently do finance and upgrade the infrastructure of big cities. We do not upgrade the financing of small towns. How do you deal with small towns? Well, guess what? The Italians actually found a solution to this. So basically what they do is they take all these different small municipalities, right, that by themselves cannot really raise capital because it becomes too expensive. And they pool them. So they all raise little mini bonds and they pool them into one single vehicle, one single larger bond, right, that essentially has, it's almost like an insurance pool, right, that has sort of the distributed risk of all these different communities. And then they sell off sort of the future performance, i.e. everyone who takes water, of course, has to pay for the water, so that they securitize all the revenue that will come from water for the next 10 years into this new bond, which they sell off in the market. So what that does is the small community by itself cannot get upgraded infrastructure, but the pooled bond can actually give all these small communities upgraded infrastructure. It really is a democratized opportunity. This one here, I just got the clearance. I could show this from Tim Sylvester of Integrated Roadways. I mean, great company, worked now with them for maybe about a year. And so basically what they are, their technology is a smart slab or a smart asset, I guess, that can get integrated in roads. The whole idea is, can we turn non-revenue generating assets, roadways, into revenue generating assets? Essentially, they're precast concrete, sensor equipped, and then roadside data computing assets that actually capture all sorts of data, can get resold into all sorts of data markets. And this is where the new revenue streams or potentially new business models around the road come from as well. So instead of needing a toll road, you actually collect the data that can get restructured and sold into all sorts of data markets. So here, high potential, upside potential, Of course, also higher risk. It doesn't necessarily fit into every builder's code book, right? As he was telling us yesterday. So, but it's these types of integration of digital assets into real assets that is becoming the future of infrastructure, infrastructure construction, infrastructure financing, and infrastructure management. So ending up with this slide, so ultimately, is smart infrastructure finance a new meta discipline? Clearly, I think so. I mean, when I came back from Finland and I talked to the chair, I talked to a number of our faculty members, generated a lot of excitement, because a lot of the faculty are, and not only here, but sort of other universities as well, are working on making assets smarter, collecting very diverse sets of data, whether it's 5G compliant or not, let's leave that in the middle, but all types of data collected from real assets that leads to that whole digital twinning, leads to insights, which the banks, the ratings agencies, the regulatory, the regulators, the ESG reporters, and everybody else is actually using to start repricing and rethinking the value of that asset, whether that is ESG, whether it's operations, whether it's an efficiency, whether it's whatever it might be, or new cash flows. And then the question is, one, can we reduce the cost of financing? And two, which we know is already happening, two, can we generate new cash flows like what Integrated Roadways is doing? And can these new cash flows be used as a funding mechanism to pay for the financing of the infrastructure? And so it sort of becomes a whole closed loop system. And basically our group is really focused around all four quadrants. So if I talk, so now I'm taking it sort of into Michigan with the last couple of slides here, who are partners. I mean, Nuveen, sorry, Ripple was an early funder of the group at the University Blockchain Research Initiative of the company Ripple. It's a blockchain company, and we're looking at sort of blockchain financing mechanisms of infrastructure. WSP in different capacities. Nuveen, of course, is TIAA. Many of our pension funds are tied into that, so we're very, very vested in this company. They're very interested in building ESG models across all verticals of infrastructure assets. And Dan and Daniel and others in the group, I mean, have been involved in this. Equarius Risk Analytics, which is a startup company that deals with risk pricing, the impact of water on operations of all sorts of assets. Blockchain Triangle, already mentioned them. He's actually an alum from the School of Art and Design who came back to us way back a few years ago, integrated or incorporated in Bermuda, hence the triangle. And so they're very much into that whole reporting. The Great Lakes Impact Investment Platform, those who have taken my courses have heard Dave Nafzger speak in that class. Limnotech, one of the earliest startups out of CEE in 1975, still working with them. Integrated Roadways, Office of Technical Assistance of the Treasury, Asian Infrastructure Investment Bank, CDM Smith. We have conversations on wireless charging, IJ Global Infrastructure, and an InfraClear, which is a natural language processing company that looks at contracts and sort of tries to distill efficiencies in the contracting system. So when we look at the research areas, I grabbed this from our, as I said, pending websites, should be ready in another month or so. So what are we working specifically? ESG and green premiums in bond pricing. We want to make bonds even cheaper for city, states, and counties by integrating and connecting in ESG data and green data. Water risk pricing and equities and indexes. Infrastructure asset tokenization. What that is really making infrastructure essentially taking the digital information from infrastructure and convert it into a token. It could be a security token, it could be a utility token, it could be a payment token for retail investors, for example, to invest in infrastructure assets. Demand-driven harbor financing. This was the work that Dennis Shagru did when before he left, and we're still continuing some of that. So basically, instead of having it all, the harbor financing all be driven by by government, sort of have it be driven sort of based on the needs of the ships. And then finally, the last slide, the second to last slide, sustainable agriculture financing. This is a project together with the Great Lakes Protection Fund, where we're looking at new financing mechanisms that incorporate ESG metrics in the context of loan pricing and farm valuing. And so we have all sorts of banks and all sorts of other types of partners involved. Business and financing models for connected vehicle integration. This is a collaboration with Professor Liu and our chair and a number of students that are working in this space. Connected vehicles, I mean, what are going to be the new financing and business models around that as they integrate with infrastructure. Infrastructure performance management using blockchain. Both Kenneth and others are starting to get involved with this together with our partner Blockchain Triangle. How do we actually manage sort of information on a blockchain? And so I want to sort of conclude this. This was a lot of information. I fully agree. I mean, one, that finance is kind of an odd thing to put in CE, but you know, we build the largest infrastructure assets that exist, right? We really have to be very cognizant of the financing mechanisms as well as the funding mechanisms behind that. And the more and more that finance becomes essentially a technology, hence financial technology, and the more finance is going to be related to data. I think as we are moving forward more into a digital research space, the connection between data and financing becomes incredibly important. So public asset owners in the future will become infrastructure service providers, right? So the future of democratized digital project delivery is really all about making sure that economically disadvantaged communities will not be underserved, but actually have also a capacity to generate revenue from assets that don't necessarily come or charged on the back of the citizens in those communities, but actually can get it out of the data markets, right? So the capacity for a community to bond is dependent on its tax base and ability to pay for services. Because of income inequality, we have had haves and have-nots, and we all know many examples with access to quality infrastructure services. So by integrating digital infrastructure, not just 5G, but, you know, as I said, real assets such as integrated roadway, smart slab in our city assets can decouple, or at least to some extent, you know, shift or reduce the dependency of the financing and of the funding on the income distribution and taxes, right? So we can get money from elsewhere. Key enablers, I already talked about them. So I put this paper out there. There is another way to pay for infrastructure projects. And, you know, it's about 2 pages long. For those that are interested, I'm happy to send it. I've been at the university for about 30 years, published many papers, done many, you know, given many talks and whatnot. This has generated more interest than probably anything I have done in the past 30 years and has led to all sorts of very interesting, I should say, derivatives, to use a financial term, and new opportunity, not just for the research group, but for the department in its new strategic area. And with that, I want to thank you all for, hope you got something out of this, and happy to take some questions.
Thank you, Peter, for your insight talk. So this is very timely subject, given what is happening in our infrastructure and the financing. So now let me invite all the panelists. Okay, so I would like to start with each panelist take on the Peter's talk. So I would like, Brittany, are you interested in starting first? And then we'll go with Mayank and team. So Brittany.
Sure, thank you. And Peter, thank you so much for always a great presentation. This is a very exciting new area of research. I had dinner recently with a few water folks in our circle who really love this idea of democratization of data to serve underserved communities. You know, we've seen in the state of Michigan alone, Flint and Benton Harbor and other places really struggle with these, but they aren't the only ones. The University Research Corridor, we engaged in an effort a few years ago to work with Peter and colleagues across the corridor. That would be Michigan State University, the University of Michigan, and Wayne State University, along with a number of governance folks, practitioners, in an effort to find how do we tackle some of the challenges between research and practice? How do we tackle the financing piece as part of a network? And so this represents a really interesting piece. The other thing the URC has done is we've gone into communities and engaged with them to try to better understand what they're experiencing. Places like Monroe, Michigan, for instance, and Kalamazoo. And you're right. There's the costs associated with adopting innovation, whether we're talking about technological innovation or financing innovation. And then there's the risk. And it's not just in terms of financing risk, but the risk of adopting a new technology if it's going to fail and not achieve the objectives. And so, they struggled with both of those, and those are big barriers. I know we're going to get into more of that. And I'm curious to discuss more this important opportunity with the data to not only be a financing mechanism, but to also reduce some of the risk inherent in some of these smaller communities in adopting new technologies. There's a lot on the line, and particularly now with the infrastructure bill passage, that's a once in a generation funding, right? But it's one-time funding. And it seems to me what you have presented is an opportunity to use this one-time funding to get on the next 30, 50, 70-year model that will make it sustainable over time. So I'll pause there.
Okay, thank you, Brittany. Mayank?
Yeah, thanks. So one word that kept coming up was sustainable green. And I honestly feel that the path to a green future is paved with zeros and ones. It's going to be digital that gets us there, because what's going to happen is when you start building new infrastructure, you need funding, obviously. And to fund those projects, you need to raise that fund somewhere. And I feel tax holders or taxpayers will become a lot more aware of what it costs them. For example, the carbon tax is really costing us. People see it. I mean, even in Canada, it's become a national platform for the Conservative Party to cancel the carbon tax. I don't think it'll go away, but the point I'm trying to make is once the costs go up so high, then accountability comes with that, right? And so the politicians will have to probably make these assets, the state-owned assets or the country-owned assets, a lot more transparent. What that does is gives me some sort of comfort level that my money's being spent well and that kind of stuff. It's not just a national problem; it'll be an international issue, because after COP26, I think a lot of the developing countries push back, saying that look, we can't manage this. So I think what's going to happen is the West is going to fund a lot of this energy transition towards a sustainable future for the globe. And if the West is paying for the bills in developing countries, they'll want more transparency. So I think digital is very, very important for transparency, trust, and all that stuff. And I think the three things that you need to get there is vision, integration, and funding to even deploy these technologies. So vision is basically the thought partnership, thought leadership, stuff that we're doing right now. Integration is multiple players coming in the same room to give integrated services. So engineering companies, financing firms, startups, so large and small companies, municipalities, governments, all that kind of stuff. And the third is funding, and that's always been a challenge. Like, who's going to fund? Who's going to take the risk? We've tried to deal with the municipalities. They take risk on a very small level. Like, we've done projects in Denmark, giving them a lot of transparency in their waterways. We measure every variable that needs to be measured. WSP Australia does coding for a lot of the water plants in Sydney. We've digitalized those operations. I hope more of that happens. More of the municipalities, take that leap. But I just don't see it any other way. I think I think both of these are in tandem, and we'll probably have to go where Tim is already there. So, I'll pass it on to Tim.
Yeah, Tim,
thank you.
please.
I go back to Peter's slide where the unfunded liabilities, unfunded infrastructure liabilities, half of those were surface transportation assets, roads, bridges, highways, interstates. And we think a lot about the digital economy, but all of us eat food, we live in houses, we go to places, and we rely on the physical economy, which in turn relies on our transportation infrastructure. So how is it that the transportation infrastructure that we all rely on just to survive is the largest unfunded liability that we have as a society? It is so important. And yet, if we think about the market dynamics, in my opinion, the reason that we have this big gap between dependency, funding, and financing is because the means and the methods have not evolved significantly for about 100 years, right? 100 years ago, the automobile was invented and popularized, and we said, well, the government will just pay for all of this with taxes, and called it a done deal. Well, it's not a done deal. Look around you. How many of the things that you use in your life are 100 years old? How much has your phone, your computer, your television, the online economy advanced in the last 10 years versus the advancement of our physical infrastructure in the last 100? So if we can realign our physical infrastructure funding and financing with the needs of modern society, these problems will resolve themselves. And in my opinion, it comes back to ensuring that the services that we get from our infrastructure match the market demands and needs for the next generation of our mobility systems, our communication systems, and our infrastructure systems need to evolve dramatically in order to meet those needs. So there's obviously a lot more to be said than that. And I'm more than happy to have that conversation anytime anybody would like. But I want to send it back because I know we have several questions that would like to be asked.
Yes, thank you, Tim. I think we'll also get into the little bit deeper more about all the panelists talked about, of course, the Peter's talk. So some questions that we have for this is Peter in the last slide briefly mentioned about the key enablers of these smart infrastructure financing for our infrastructure, like revenue from the data market and smart contract and etc. So in the panelist view, what is the biggest enablers for smart infrastructure practices to become mainstream? So maybe Tim, you just want to continue to.
Yeah, of course. So my view is that the biggest enabler is going to be the recognition of the existing market demand for these capabilities. I mean, internet companies largely base a lot of their value on the collection of traffic data from internet visitors. And I believe that this traffic data for physical infrastructure provides just as much, if not more, value. Right now, data collection methods are archaic, they're wildly expensive, and they're primarily devoted towards operation and management needs for public agencies. But let's think about the physical economy. All the brick and mortar businesses, the real estate developers, the property managers, the tenants, they can gain enormous value from the collection and analysis and utilization of the roadway traffic data, if only the means and the methods to collect, analyze, and disseminate that were modernized in order to match what we're actually capable of. One reason that it's so valuable and profitable with online methods is because the collection is built into the infrastructure. So what if the data collection were built into the infrastructure that we rely on for our physical economy? The price would drop significantly, the value and the utilization would go up dramatically, and now our brick and mortar economy would be able to get the same advantages that our online economy does.
Thank you, Tim. Anyone who would like to add to this point?
I can give you my viewpoint. From my side, the enabler is funding, right? We've got enough engineers to solve these issues. We've got sensors that can measure everything. We've got really bright people, and you can pull on a global pool of talent pool. For me, it's funding. So I'll give you an example. Like WSP right now is scaling up a technology that was developed in Quebec by 4 professors. You take garbage, you burn it, and you get fuel, right? And it's called Enerchem. That the company is called Enerchem. It's public information. And we're now building a $1 billion plant for Shell and Suncor and all these 2 or 3 firms. The whole point was funding. Otherwise, a professor would never get funded, right? Like, so that for me is a big deal. If funding is available, everything is possible. And the problem is, banks are too traditional, and Peter and I have had a lot of conversations, a lot of banks about this. VCs have started softening up for some reason. And then the third thing is, you've got hedge funds, startups who, take the plunge. So, brave people like Tim who go out there and get stuff done.
Okay, thank you. Brittany, you want to add something? Yeah.
Yeah, and I might come at it a slightly different approach, with the university perspective. So let's make it interesting. I think that financing and the funding is one component of it. Our universities, we found over a 5-year period, our universities do somewhere in the neighborhood of $1.64 billion in infrastructure related R&D. And yet we're still using a lot of older technology, as was pointed out. How many things are 100 years old? That's a good question, Tim, besides my house, right? The point being, there's no shortage of innovation. There's no shortage of funding for innovation. There's no shortage of startups like Tim's and others to get out there. But what we are short on, I think, is trust, and we're short on, and recently we're not short on money, right? I mean, we're talking to communities who are looking at getting more money than they've ever seen to their municipalities, and they're freaking out. They have no idea how to spend it. It's high stakes for them. Mm-hmm. What's worse than not having the money is having so much and failing to use it effectively. And so, I think before the funding, I might have agreed with you, Mayak, but I also, from our conversations and being out there in communities, I think the biggest barrier is probably trust. And, the trust that this technology, if they implement it, they aren't going to get burned later, that it's not, it's going to be seen by their communities as a failure in some way, or worse off than what they already have. Sometimes the devil is better than the one you don't. And so I'm particularly intrigued, Peter, in the Italian example that you gave of the collective. I think we need to talk offline. I'd like to learn a little bit more about that example in particular, and how that worked. And it was a way, I think, to mitigate some of their risk profile through the collective. Am I understanding that correctly? Yes. Okay. So, I think, finding ways to do that. And the good news is you can structure, like the Italian example, from what I understand, you can structure a way to de-risk new technology, new innovations, whether it's for the actual technology or the financing mechanism. But I think too, you can de-risk it through greater relationship building, so that you have a strong research to practice to research engagement level. And I know all of you have gone out and you have, some communities you're stronger with than others, and you usually get more traction. And we're humans, we're people, and we can trust more when we get to know folks better. And then, of course, a healthy dose of competition could help as well, because if one community does something and it's proven to be successful, then it puts the pressure on other communities to follow suit. So a little bit of different take than you guys.
Let me just add to that. Just one sec. So when we built the Master of Smart Infrastructure Finance, I went around and talked to many of our alums at banks, Citigroup and other places and Nuveen and whatnot. I said, well, what do you think should be in it? What should we be teaching, right? And there was one person, he's an IOE grad from many years ago. He's a EVP at Citigroup. And he said, initially it was going to be a half-hour meeting, ended up being a 2.5-hour meeting, which is great. Ended up talking in New York to him. And he said, whatever you do, don't generate a bunch of number crunchers. We have tons of number crunchers. What we want is people that understand the soft side, because there's no Muni project that will ever come off the ground based on numbers, right? It's, as you said, it's back to that trust, right? It's back to that communication. It's back to, okay, you're going to do this with data. Wait a minute, what data? Personal data? Whose data? What are you monetizing? Who's disadvantaged, right? There's all these other derivative concerns around that. So just wanted to amplify what you just said.
So can I ask a question, Peter, of that? I mean, when I was listening to you and even thinking about this for the last couple of weeks, you know, I know we're focused in this on the finance, the data to help us finance a lot of these smart infrastructure projects. But I'm also curious, you know, we've had some horrific things in terms of infrastructure in different places around the state, the country, and even the world. And so you know, in looking at ways to build trust or mitigate risk, you know, how can some of this data also be used to make it stronger? You know, sensor technologies we talk about a lot. They're on the Mackinac Bridge. It helps us know where there might be weak spots, and that, I think, that kind of innovation lends a lot to people having greater trust in adopting some new technologies. Could you maybe, I don't know, I'm curious about how you're thinking about data in those two levels.
I mean, data is about risk management, right? In the first place, understanding. Mayank and I have been talking a lot about that, you know. So data, and how much data, and what kind of data, and where does that get you on the risk curve, right? Does it get you more in the red? Does it get you in the green? How far in the green do you want to be? In the green, I mean, not money wise, but also risk wise, whichever way you want to profile your risk. So yes, we do think quite a bit about that. Data as a risk management strategy. But yes, here it was about finance. And I'm cognizant of time, even though I did go over a little bit. Sang-Yoon, I know you have another question. I want to make sure that we get that around to the team. And we can follow up separately on the Italian example.
Yeah. So I think for the sake of time, I will go with one more question, which is actually continuation talk of our previous discussion. So, you know, in terms of key enablers, the team emphasized the recognizing existing market demand, and Mayank emphasized the funding, and the Brittany emphasized the trust. So now I think the key player in all those things that you emphasize is actually municipalities and the local government. So I would like to conclude with our last question, which is, what are the challenges that make municipalities adapt to these new technologies? So Tim, can you go first?
Yes, the biggest challenge is the way we've always done it. That is the single challenge to overcome, because it points to outdated procurement. And, you know, the way that we've always done it, we've been buying roads the same way for 100 years. Just because you've been doing something for a long time doesn't mean that it's a good solution. So like, we need to update our procurement so that we're not looking at the cheapest way to deliver something on day one, but the cheapest way to own and manage that thing over its entire life. You know, instead of pushing O&M expenses off to somebody else's problem later, let's roll it into a life cycle cost analysis that includes the costs as well as the revenues and the incentives, and figure out what is the biggest benefit cost ratio that we can get out of something. And it's not just the benefit cost to the public agency. That's usually what we think of, but the public agency is just the administrator of the public good. So let's concern ourselves with the benefits to the community, the private community and the commercial community. What does everybody get out of these improvements? Do we get data collection that is more than just O&M for the city or the state, but is also valuable for the commercial economy in the area? Do you get communication services, fiber services? Do you get wireless charging for electric vehicles? Do you get navigation for autonomy? Do you get the ability to upgrade the infrastructure over its life so that it continues to be relevant and becomes sustainable from the first time that it's installed until when it's replaced several generations later? So One of the classic statements for infrastructure innovation is that as soon as it's proven to work, we stop using it. And that's because as soon as it's proven to work, we stop getting grants for it. And if we don't have grants for it, then we can't afford it because it's not the cheapest possible solution. So if we fix this expectation that technology has to be cheaper up front, and that we should always buy on the low cost, and that we should use 100-year-old methods to do everything, suddenly we now have this new world of opportunities available.
Thank you, Tim. Mayank, you want to briefly add something? Or?
Yeah, so just a comment on what Brittany said before. I totally agree with her. What I meant is funding is not available for like these new frontier projects because they look at it as expected value and say probability of failure is really high, hence you will not get the funding, right? But it's good to know there's a lot of money available. We just need to be better at convincing folks. I think for municipalities, in the future, they won't have a choice. I think right now, a lot of the municipalities that I've talked to in Canada, and these are the biggest water municipalities, or have the biggest water treatment plants and all that kind of stuff, they're all thinking digitalization. There's no other way to go forward. And historically, they would take a water plant and double, triple the size of it and never had to worry about it. So they basically built reliability day one for year 100. And that is not a right way to do it, right? It's basically what Tim said, why are you paying for everything right now? So in the future, when you add carbon taxes and all that stuff, they'll have to scale that back. They will turn to digital technologies. And I think as soon as the Saudis finish NEOM, the smart city, there's going to be a wave of demand for smart cities. And I'm hoping, all of this, what we're talking about comes true then.
Thank you. Brittany, you want to briefly wrap it up something about this?
I would only add in, I fully agree. And being the generalist in this group, I know probably the water infrastructure a little bit better. And I would just add from the Midwest here, I think another area that probably would need to be addressed is the fact that anytime you want to do something innovative, water related, and I assume in other types of infrastructure projects, you have multiple layers of oversight, whether it's, first the local, then the county, then the state, then the EPA, and so on and so on. And it's a lot of red tape that makes adoption of new models very difficult for projects. So that's a policy probably challenge and needs to be addressed.
Okay, thank you. Thanks, Peter, again, and thanks for our panelists for your great discussion. So also thanks everybody for attending.